Most traders believe their problem is technical. They think the reason they keep losing is because they haven't found the right indicator, the right setup, or the right entry model yet. So they jump from system to system, from strategy to strategy, convinced that somewhere out there exists a method that will finally make everything click. But after watching thousands of retail traders over the years, one pattern becomes impossible to ignore. Most trading systems don't fail because they are bad. They fail because they are built for the wrong person. If you strip trading down to its core, a system is not just a set of rules, it is a behavioral contract. It demands specific reactions under pressure, specific levels of patience, specific responses to uncertainty and drawdown. And if your personality naturally violates those demands, no amount of discipline will save you for long. This is why two traders can trade the exact same strategy, in the exact same market, with the exact same rules, and end up with completely different results. One survives, the other self-destructs. The real question is not, how do I build a profitable trading system? The real question is, how do I build a system that I can actually follow when it matters? Because the market doesn't punish ignorance as much as it punishes mismatch. And personality mismatch is one of the most expensive mistakes retail traders make. I've seen impulsive traders force themselves into slow swing systems they can't emotionally tolerate. I've seen analytical traders destroy themselves trying to scalp fast-moving markets that demand instinctive execution. And I've seen patient traders abandon perfectly profitable systems simply because they didn't produce excitement. None of these traders were stupid. None of them lacked intelligence. What they lacked was alignment. Trading is not about becoming someone else. It's about building a framework that works with who you already are, not against it. To understand how to do that, we need to start by confronting a dangerous assumption most retail traders never question. That assumption is the belief that the market rewards the best system objectively, regardless of who is trading it. It doesn't. The market rewards consistency, and consistency is psychological before it is technical. Before we talk about entries, exits, risk models, or edge, we need to talk about the trader behind the system, because every system secretly encodes a personality profile. And if you ignore that, you will spend years blaming strategies for what is actually an identity problem. Let me give you a concrete context. Over the years, I've worked with traders who were incredibly sharp intellectually. They understood market structure, liquidity, macro flows, even derivatives mechanics. On paper, they should have dominated, yet they repeatedly broke rules, overtraded, or hesitated at execution. At the same time, I've seen traders with far simpler models outperform them, not because they were smarter, but because their systems matched how they processed stress, time, and uncertainty. The difference was never intelligence, it was compatibility. Your personality determines how you experience drawdowns, how you react to missed opportunities, how much uncertainty you can tolerate, and how much decision-making fatigue you accumulate in a session. And those factors matter more than any indicator you will ever add to a chart. If you build a system that demands emotional responses you don't naturally have, the market will eventually push you into breaking it. Not because you are weak, but because the design itself is hostile to who you are. This is where most retail traders unknowingly sabotage themselves. They copy systems from mentors, YouTube, Twitter, or signal providers without asking a fundamental question: is this system compatible with my decision-making style under pressure? Usually it isn't, and that leads directly to the pain that follows.
What actually breaks most traders is not losing money. It's the internal conflict between what a system demands and how the trader naturally behaves. This is the pain that rarely gets articulated clearly, because it doesn't show up on a chart, it shows up in behavior. A trader knows the rules, believes in the logic, even sees the edge on paper, yet repeatedly violates the system at the worst possible moments. Late entries, early exits, revenge trades, position size creep, hesitation after losses, overconfidence after wins. These behaviors don't come from a lack of willpower, they come from friction. Every system imposes stress in a very specific way. Some systems demand long periods of inactivity. Others demand rapid decision-making. Some demand emotional neutrality during deep drawdowns. Others demand the ability to sit through boredom without creating trades out of restlessness. When a system's stress profile conflicts with a trader's personality, the trader unconsciously tries to fix the discomfort, and the market punishes that attempt immediately. For example, a naturally impatient trader placed inside a swing trading framework will feel constant psychological pressure. The market moves without them, setups take days to form, price drifts sideways. The trader starts checking charts compulsively, entering marginal trades just to feel involved. Over time, the system deteriorates, not because it doesn't work, but because the trader cannot tolerate the waiting. On the other end of the spectrum, a highly analytical trader forced into fast intraday trading will struggle in a different way. Execution speed becomes a problem, decision latency increases. The trader second guesses entries, misses optimal fills, and freezes when price accelerates. Losses feel chaotic rather than controlled. Eventually, the trader either hesitates themselves into underperformance or overcompensates by forcing trades late. In both cases, the pain looks technical on the surface, but the cause is psychological mismatch. This is why copying another trader's system almost always fails in the long run. You are copying the rules, but not the nervous system that was built to execute them. Retail traders are especially vulnerable here, because most education focuses on structure, indicators, and strategy logic, while almost completely ignoring behavioral constraints. No one asks how you react to boredom. No one asks how you respond to uncertainty. No one asks how your attention degrades after an hour of screen time. Yet those variables quietly determine whether a system survives contact with real money. Eventually, something breaks. And when it does, the trader usually reaches the wrong conclusion. They assume the system is flawed, so they abandon it and move on to the next one. The cycle repeats. New hope, new rules, same internal conflict. After enough repetitions, frustration sets in. Confidence erodes. The trader starts to believe that profitable trading is reserved for a special type of person they are not. This is the real damage, not the loss of capital, but the loss of self-trust. The turning point comes when a trader realizes a simple but uncomfortable truth. The goal is not to become more disciplined. The goal is to design a system that requires less discipline to follow. That realization changes everything. Instead of asking, how can I force myself to follow this system, the trader starts asking, what kind of system would I naturally follow even under stress? This shift reframes system design entirely. At that moment, the trader stops treating personality as a weakness to overcome and starts treating it as a constraint to engineer around. That is where real systems begin. A personality-aligned system does not eliminate emotion, it accounts for it. It assumes certain reactions will happen and designs safeguards accordingly. It reduces the number of decisions where the trader historically makes mistakes. It structures time, frequency, and risk in a way that matches how the trader processes information. This is not theory. This is observable in every professional environment where performance under pressure matters. Pilots, surgeons, athletes, and military units do not rely on discipline alone. They rely on systems designed around human behavior. Trading is no different. Once a trader understands this, the entire conversation about edge shifts. Edge is no longer just about market inefficiencies. It becomes about behavioral efficiency, about reducing self-interference. And this is where the real insight begins. Because building a system around your personality is not about categorizing yourself as patient or impulsive. That's too shallow. It's about identifying how you fail under pressure and designing the system so those failure modes have minimal impact. Some traders fail by acting too quickly. Others fail by acting too slowly. Some fail by overtrading. Others fail by undertrading. The system must be built to constrain the specific way you sabotage yourself. Until that happens, no strategy will ever feel stable.
Once you accept that personality mismatch is the silent killer of most trading systems, the next step is understanding how professional traders actually build systems around human behavior rather than against it. At the institutional level, no serious trading operation assumes that traders will behave perfectly. Systems are designed under the assumption that humans are inconsistent, emotionally reactive, and prone to fatigue. The edge does not come from eliminating those traits, but from structuring decision-making so that their impact is minimized. This is where retail traders misunderstand what a system really is. Most retail traders think a system is a setup, an entry trigger, a stop-loss formula, a take-profit ratio. That's only the surface layer. A real system is a behavioral architecture. It governs how often decisions are required, how much discretion is allowed, how long uncertainty must be tolerated, and how errors are absorbed without catastrophic damage. To see this clearly, consider two traders with identical market knowledge but different psychological profiles. Trader A processes information quickly but becomes emotionally restless when inactive. Trader B processes information slowly but maintains emotional stability over long periods. If both traders attempt to trade the same strategy, say a low-frequency swing system, the results will diverge dramatically. Trader B will likely perform well. The system matches their tolerance for waiting, their comfort with delayed feedback, and their ability to hold positions through noise. Trader A, however, will experience constant internal pressure. The system will feel slow, even when it is statistically sound. Over time, Trader A will introduce discretion, take suboptimal trades, and increase frequency to relieve discomfort. The edge collapses. Now, reverse the scenario. Place both traders into a fast intraday system with multiple decision points per hour. Trader A thrives. Speed reduces anxiety. Constant engagement stabilizes focus. Trader B, however, becomes overwhelmed. Decision fatigue sets in. Execution quality drops. Missed entries turn into forced trades. Again, the edge collapses, not because the system changed, but because the operator did. This illustrates a critical principle. There is no universally optimal system. There are only systems that are optimal relative to the trader executing them. Professional firms understand this. That's why discretionary traders, systematic traders, scalpers, and portfolio managers are separated into roles that match their cognitive strengths. You rarely see a slow, methodical macro thinker running a high-frequency execution desk, not because they're not intelligent, but because the role would extract the worst version of their decision-making. Retail traders, by contrast, are expected to be everything at once: analyst, execution engine, risk manager, psychologist. And without realizing it, they choose system styles that amplify their weaknesses. Let's ground this in a concrete case. A retail trader I worked with had a solid understanding of market structure and liquidity. On backtests, his strategy performed well, but in live trading, he consistently exited early, missing the core of the move. His system required sitting through prolonged consolidation and accepting unrealized profit fluctuations. Psychologically, he couldn't tolerate that uncertainty. Instead of blaming discipline, we redesigned the system. We reduced target size, increased win frequency, and added time-based exits. On paper, expectancy remained similar. In practice, execution improved dramatically. Why? Because the system no longer demanded emotional responses he didn't naturally have. The system absorbed his personality rather than fighting it. From a smart money perspective, this is how real edge is protected. Large players don't obsess over perfect prediction. They obsess over survivability and repeatability. A system that performs slightly worse statistically but can be executed flawlessly will outperform a theoretically superior system that breaks down under stress. This is why institutional systems are often boring. They are designed to be boring. Excitement is noise. Noise increases error rates. Retail traders often reject boring systems because they don't stimulate engagement. But stimulation is not performance, it is dopamine, and dopamine-driven systems are structurally unstable for most personalities. Another critical insight here is that personality is not fixed in labels, it is situational. Traders behave differently under drawdown than they do under confidence. They behave differently after a winning streak than after a loss. A personality-aligned system accounts for these state changes. This is why risk rules are often more important than entry rules. Risk constraints act as psychological circuit breakers. They limit how much damage a trader can do when their internal state deteriorates. In other words, the system is not there to maximize profit in ideal conditions. It is there to protect the trader from themselves in non-ideal conditions. Once you understand this, system design becomes less about optimization and more about containment. You are not trying to extract every pip or tick. You are trying to build a framework that allows you to show up consistently without self-sabotage. That is the insider perspective retail traders rarely hear.
Once the idea of personality-aligned systems is understood, the final step is turning that insight into something usable. This is where most traders fail again, not because they lack understanding, but because they try to apply the idea abstractly rather than structurally. Building a system around your personality does not mean trading whatever feels comfortable in the moment. Comfort can be deceptive. What matters is identifying the specific conditions under which your decision-making degrades and then designing rules that neutralize those conditions before damage occurs. The first practical step is reducing discretionary pressure. If you are a trader who tends to act impulsively under uncertainty, your system should not require frequent subjective judgments. You should not be asking yourself whether a setup is good enough multiple times per session. The system should define narrow conditions for participation, even at the cost of lower trade frequency. Fewer decisions mean fewer opportunities for self-interference. The second step is aligning time exposure with your cognitive stamina. Some traders perform well for short, intense periods and then deteriorate rapidly. Others maintain stable performance over long durations but struggle with fast execution. A system that ignores this will inevitably fail. If your focus drops after 90 minutes, the system must limit exposure beyond that window. If you struggle with speed, the system must operate on higher time frames where decision latency is not punished. The third step is designing risk as a behavioral constraint, not just a mathematical one. Position sizing should reflect not only account size, but emotional tolerance. If a loss causes hesitation on the next valid setup, risk is too high, regardless of theoretical expectancy. A smaller position that allows consistent execution will outperform a larger position that destabilizes behavior. These adjustments often look trivial on paper, but they radically alter performance. The system becomes easier to follow, not because it is simpler, but because it no longer demands personality traits you do not possess. This is where many traders experience a quiet but profound shift. Trading stops feeling like constant resistance. The urge to override rules diminishes. Execution becomes less dramatic, less emotional. Not because the trader has become disciplined overnight, but because the system no longer provokes their weaknesses. And that leads to the final realization. The purpose of a trading system is not to extract maximum profit from the market. Its purpose is to allow you to survive long enough to compound a small edge consistently. Markets are not beaten by brilliance, they are beaten by longevity. When you stop fighting who you are and start designing around it, trading becomes a process rather than a performance. You stop trying to prove intelligence. You stop chasing excitement. You stop comparing yourself to traders whose systems were never meant for you. At that point, the question, "What system should I trade?" becomes irrelevant. The real question becomes, what system allows me to show up tomorrow, next month, and next year without breaking? That is the system worth building. If this way of thinking feels different from what you usually hear about trading, that's intentional.
Most education focuses on markets. Very little focuses on the trader inside the market. Yet that trader is the constant variable across every win, every loss, and every blown account. If you want to keep going deeper into this way of thinking, how professionals structure systems, manage behavior, and survive long enough to let edge work, subscribe to the channel. This is the work that actually changes outcomes, even if it never looks flashy on a chart. Master yourself. Master the markets.